Now, bank CEOs in Davos told the Squawk gang this week that they're optimistic about the economy and that the banking business is going well.
In the U.S. in particular, the underlying strength of the consumer continues to be very, very strong.
The economy is doing fine. If you look at, and 2020 just began, but the consumer, people remember, is strong. 70% of the GDP is the consumer.
Banks have been the unloved sector of the last couple of years, and that will turn, and I think it's starting to turn.
Our stock is still cheap, and the financial sector is still cheap relative to the industry, but that's a given.
In the past 3 months, the financial sector ETF has gained about 8%. So can you still buy banks right now? Joining us now, Marty Mosby, Director of Bank and Equity Strategies at Vining Sparks. Very good morning to you, Marty. Why don't we pick up, first of all, with the story we were just discussing. I mean, do you think Mr. Diamond's worth the money he's paid?
Well, there's a very big dichotomy when you're talking about that. When you talk about the shareholders and the dollars that's made from the stock market, most of this is performance-based, so it's related to that. So the investors are aligned with the executives. So that's one piece of the puzzle. The other side of it, though, is the compensation and the discrepancy between, like you said, the managers and the people on the front lines that are, as important as the head person. So, pulling that together, I think, is, again, is pulling those two pieces together. It's going to be the basis of where we kind of go from here. But there is a big difference there, and there's some things that can be addressed to make that a little bit better for everybody.
On the flip side, I'm sure you saw the story about Wells Fargo. What do you make of the $17.5 million fine for John Stumpf, the former chairman and CEO, which clearly has come quite a few years after the original regulators' revelation of this scandal, the CFPBs, which was 3.5 years ago. So what do you make of the timing and the size of this fine?
Well, I mean, what we're looking at here is a regulator looking back at a manager, an executive, and they're trying to set a tone at the top. They're trying to say, okay, if you're going to get paid this amount of money, then you're going to be held accountable to make sure that you're looking at all the pieces of your company and not allowing these kind of things to happen. So you can tell that, you can feel that would be a shudder through many of these CEOs that are accumulating some of this wealth that we just talked about, that can lose it if they don't take a very strict focus on how they're looking at compliance and how they're making sure that everything is being taken care of within their companies.
Hey, Marty, it's Scott. Good morning to you. The setup for the banks coming into the earnings season was tough, most notably because the bank stocks had done so well coming into the numbers. Now that we got the numbers, what do you make of the stocks right here?
Actually, the fundamental improvement that we've seen in the banks has been very consistent and moving higher over the last really 5 years. What's been different is that the stock prices relate to what is the fear factor for recessions. The last financial crisis has that anxiety built into investors. So when the yield curve inverts, like it did in into 2018, coming into 2019, the stock prices do really bad. And then all of a sudden, when you start to see the fear factor move off the table, you start to see the stock prices do really well. So fundamentally, what we saw in this earnings season is no different than what we've seen in 12 in a row, consistently moving higher, about 15-16% return on tangible common equity, underlying tangible book values growing, and you still got a 2.5 to 3% dividend yield.
Can you still buy the names? I'm looking at, the J.P. Morgan, Morgan Stanley, Goldman. They're all only a couple of bucks off of their 52-week highs.
We think you have to be much more selective. The higher quality names like J.P. Morgan, Bank of America has been a real favorite over this process. That's where the generalists kind of come in and out. They're in right now, so those valuations have been pushed up. But if you look at super regional banks that have a little bit out of favor, but then have some very intrinsic things that they're doing. Citizens Financial Group continues to grow loans, expand their business on the fee income side, buy back capital, and has a really good efficiency program in place. So those are the kind of banks that we think there's still some relative value you can find here.
What do you think of Brian Moynihan saying that he thought that the whole sector was still at a discount? Does it deserve that discount because of all the regulation that's still imposed as a result of the financial crisis, or is there room for expansion there?
It deserves the discount because of what happened in 2008, 2009, and 2010. The banking sector has made a paradigm shift in the sense of its capital and its liquidity, its risk management. but it has to prove that out. So you actually have to go through a shakeout of a recession to prove that you've got a better balance sheet, you got better risk management, and then eventually will then trade up towards the market, or at least closer to that, as that's kind of come through the process. So right now we're at the high end of where we're at in the range. We've got to be selective. If that fear factor comes back in, we'll be able to gauge whether or not it's really going to happen, and that'll give us another chance to ride it back up if it is another head fake.
So if I look at the year-to-date performance, Morgan Stanley's up 8%, Goldman Sachs up 6%. The rest of the sector's down, despite initially a decent reaction to earnings for the sector as a whole. Do you think that's just because those two names were very cheap coming into this year, or have we seen with Morgan Stanley setting out their targets for the year and hope coming into the Goldman Sachs Investor Day next week that those two and the investment banks, pure play, have really turned a corner for the long term?
Yeah, I think those are two separate stocks that we got to look at. Morgan Stanley's wealth management really picked up, and that was what James Gorman was really talking about, where that's how they're going to return a lot more capital to investors and actually increase their earnings. Goldman, I think, is being a lot more transparent as to how they're going to make money. So I think those two were special situations. I think the other banks, as we just mentioned, they've all had a good run, but I think it's the companies that are going to be still focused on the lending. The wealth management, I think, is going to be great, and if you get M&A activity. So you're really going to have to see. It's a show-me story, and that's what we always have with these banks. They're discounted to the market, and each one of them has to show that they can keep on going, grow their earnings, until, of course, we see the full cycle play, as we just talked about.
Okay, we'll leave it there. Marty, thanks so much for joining us.